Welcome back to another segment of our Facebook Live. This is Noel Liu here. I am a general dentist based off in Peoria, Illinois. And today I'm joined here with my partner and buddy, Tom Bibby Varghese, and our good friend and partner, George Salas. And today's topic, we are going to be talking about cost segregation 101. So, a lot of people ask, what is it? So, we just wanted to dive a little bit into it and let's talk about what's in store for us for 2024. So, with that being said, Tom, I want to pass it on to you. You can go and introduce and let's get started.
All right, I'm so excited, guys. Today, we have an exciting topic that we're going to explain to you. A lot of people had questions about this, and a lot of people have no idea what cost segregation means. One of the biggest benefits of investing in real estate is the tax advantages. Okay, there are so many benefits, but one of the greatest benefits that a lot of wealthy people take advantage of is the tax advantages that come with investing in real estate. All of you know that Donald Trump and all these famous real estate individuals, they almost pay zero tax. We are in the process of getting to paying zero tax, but this is one of the biggest benefits of being in real estate, right? By the way, my name is Tom Bibby Varghese. I am an entrepreneur and I am a good friend and partner with Noel Liu, and we run this Facebook group. And what we do is we buy properties. I started with just a 6 unit. Now I'm invested in over 1,800 units, and I'm very excited for this topic. And one of the reasons I got into real estate is because of the great tax advantages that come with it. Okay, so as everybody knows, when you get into real estate, as one day my CPA, he had to sit me down and explain what the advantage of investing in real estate is. What he told me was, when you buy a property, you can deduct the value of the property over 27 and a half years. Okay, so if the property is worth $1 million, you take that and divide it by 27 and a half, and every year you deduct little by little. Now there's another cool thing that came out with when Trump passed the tax cuts law, and that is called as bonus depreciation. Some people call it accelerated depreciation, which allows you to take the entire depreciation deduction in the first year. So if you don't have to wait 27 and a half years. You can take that in the first year. So if a property is worth $1 million, the deductible portion of that, okay, that could be maybe 70% of the property. It could be 60% of that property. And I'll tell you in a minute how that number is calculated. And that can be deducted in the first year. Okay. So what is a cost segregation study? So the way they come up with that number is by deducting the land and the other parts of the real estate that does not go down in value. For example, all the light fixtures go down in value, all the electrical components go down in value, plumbing goes down in value, the structure, the brick may not go down in value. There's a whole lot of components in the building that goes down in value, and you are able to depreciate that which goes down in value at one shot in the first year. And that's what is called as bonus depreciation. In order to come up with that number, there is a study that need to be done, and that study is called as a cost segregation study. Basically, it separates some of the depreciable assets versus the non-depreciable assets. Like land cannot be depreciated, so somebody comes to the property and they do a detailed analysis that which is done on a property to identify and separate the cost that is associated with the building acquisition, and they categorize it into different categories and for tax purposes, and that's what is called as a cost segregation study. And that's what we're going to talk about today. So if you're not aware of it, if you own real estate in some capacity as an investment rental property, whether it's commercial or you have a separate house that you're renting out to somebody, and if you're not doing cost segregation and you're not taking that depreciation from your tax bill, you're missing out a lot. That was a lot that I just said in the 5 minutes, and I apologize if it was too much. Let me let George take the next shot at it. So maybe he'll explain it a little bit better if I did not. Go ahead, George.
Yeah, absolutely, brother. Thanks for having me, guys. As usual, I think we've got a cool thing going on here. So first of all, I am not an accountant or an advisor, right? Legally, I cannot advise people, but know that we do know this stuff because we are doing it every single day. Okay, so for me, because I am in the short-term rental space, I'm able to take the cost segregation, the accelerated depreciation, and apply it to my active income, right? So just to kind of break that down and then re-mention and piggyback on what Tom said, right? So there's a percentage of each property that you can deduct, right? Which is everything you mentioned. And on top of that, there's appliances, there's drywall, and then for commercial properties, there are other things that you could deduct as well, right? So, and it has to do with something really cool, right? So it has to do with the purchase price, but also if you buy a property and you do the improvements afterwards, it actually ends up being even better for you, right? I recently conducted a cost seg study on one of our properties. We essentially refinanced the property. When we refinanced it, I put it in my personal name and then I'm moving it over to my trust. While it's in my personal name, right, I am doing a cost seg. Maybe the plan is to move it into the trust later on, but not at this moment, right? So we're doing this cost seg, and there is about $125,000 in just one property that I can take against my active income. And now my taxable income is, like X amount minus 125, right? So, which is phenomenal, right? Now, you as a real estate investor out there, whether you are doing real estate, have been doing it for a long time, or you're just getting started, this is one of the biggest benefits. I love it. We love it. And I know you guys are doing it. We're doing it in a deal with Tom right now, right? So as soon as we finish the renovations of this exterior of a property, we're going to run a cost seg, and now that cost seg is going to apply to all the improvements, right? So it's a phenomenal strategy, guys. By the way, my name is George Salas. Forgot to intro myself here. Real estate investor of 6 years. I've done over 100 plus, I think maybe like 130 real estate deals since 2018, and I've made every single mistake possible on the book, right? And cost segregation is not one, right? So I've done anywhere from fix and flipping and wholesaling for a few years back in 2018, 19, and 20, and I've done owner finance. I've bought a bunch of properties subject to. I've done rental arbitrage real estate, rental arbitrage short-term rentals. I do purchasing. We buy value add properties, right? And then today we love buying creative finance deals and taking over these really awesome deals at really low interest rates for very little down. So a little bit about myself, but I'll turn it back to Noel here, and then we can start a crazy discussion on this Thursday night.
Yeah. Hey, one clarification for all the audience out there. So the way George is able to take his cost seg study and apply towards his active income is because he's in the short-term rental industry. So it's a little bit different when you're passive and you're doing something passive, while George is highly active in this business, right, George?
Absolutely. So think of two halves. You draw a line down the middle, right? Rental property real estate creates passive income,
right?
And that's on this side, right? And then active income, even the income that I'm paying myself from our in-house property management company is considered active income, right? So because we're drawing funds out of an active income business, your income is active, or any managerial income for managing real estate syndications or funds, that's all considered acquisition fees are active income, right? The only passive income is the income that comes passively from your rental properties. In the context of this conversation, there's other types of passive income.
Right.
And when you do short-term rentals, what happens is that income is actually considered active income. Is a trade business, right? Especially if you do 7 days or less, right? Which most of our short-term rentals are 7 days or less. So what happens, instead of having a line down the middle and you having your passive income up here, and then you're activating, trying your rental passive income deductions down here, you move that income to the right. So now you can sort of play around with the depreciation and it, because they're both on the same side, basically, right? So if think about a line down the middle, now you're making a pivot if you do short-term rentals.
Exactly.
Right?
No, exactly. That's a great point, because everyone's situation is different. And, I'm just going to throw it out. If any of you guys are looking for like an active investment offsetting an active income, George is our guy to go to, and that is through the STR loophole. That's a different topic. Today, this is what I want to talk about here. Hey guys, while you guys were talking, I was looking up the definition of cost segregation and I Googled it, right? And this is what I got. A cost segregation study is an analysis of the cost associated with a property. As your building ages, depreciation occurs and decreases the value of your property over time, typically over a 27 and a half or 39-year span. When it comes to determining deduction amounts, the IRS treats the building as a singular unit, taking the purchase price minus the land and dividing it into 27 and a half or 39 years. This means that your first year deduction would be the same as your last year's deduction. The problem with that is if we just went to a local or a regular CPA and you just tell them to do a cost seg, this is exactly what we're going to get, which is why I think we need to start thinking if you are a real estate investor or an owner, got to get that study done because now with that study, the whole building is not treated as a singular unit. Instead, like Tom said, it can be broken down into windows, shades, appliance, flooring, roofing. I mean, everything has its own time span. So, with that being said, Tom, the reason we do a study, and because this is 27 and a half to 39 years, what have we been experiencing over the last 2 years, and what's going on as we move year after year with
Yeah,
this whole thing?
that's a great point. So, as I said, like the cost segregation will give you a report saying the depreciable parts of this building is worth, let's say, an X amount, right? And it'll give it to you, and then you can depreciate that over 27 and a half years if it's multifamily, and if it's a commercial office building is 39. Is it 39 or 39 and a half?
Multi,
39 years, right?
39 years. So
single
that's a distinction. So now the last, I think, started 2018, the as part of the Tax Cuts and Jobs Act, which Trump administration passed, they said you don't have to wait 27 and a half years.
Right.
We are going to give you 4 years, which was 2018 all the way through 2022,
Yeah.
to depreciate instead of waiting 27 and a half years, that amount can be depreciated entirely in the first
In the
year.
first year, right?
And then they said, this is great, but we are not going to allow you to have this for the rest of your life. Starting with 2023, it's going to be phased out with 20% every year. So if from 2023, it comes down to 80%. 2024, it'll be 60%. And then it gets phased out. Although there is some talk in the Congress right now about renewing it. If they renew it, that'll be great for all the real estate investors. So that's what Noel was talking about in the last 4 years, what's going on, where a lot of activity in real estate was simply happening because not because the numbers were good, they were just buying it because they can take the depreciation and write off a bunch of income.
Yeah.
Right. So it's like anyone owning a business, it's like the Section 179, right? Instead of
Yeah.
having the depreciation, we're just taking it all under 1 year and just writing it all off and offsetting our income. So that's exactly what this does. So I'm not sure if you guys heard about it in the news right now. It's like the deadline is, what is it, Feb 15th, right, to get the study done. That's what I
Mm,
for to take advantage in this for this year for 2023, and I think they've extended by another like 15 days or something.
Really? I mean,
I was not aware of that one.
yeah, I was not aware of that
Yeah,
too.
I just came to know about it today from the cost seg guys. They were like, "Hey, the deadline was till the 15th of this month, and now it's extended all the way up to what is it, 28 or 29? Is it a leap year? It is, right?
29,
Yep.
29
It is. It is. Yeah.
Yeah, so it's extended up to 29. So we have up till February 29 to do the study done if the property was closed last year or if it was closed like earlier this year to get that April 15 deadline, to meet that deadline to write it off.
Hmm.
So
That
I don't
was that
know. That's what I
information.
heard. So correct me if I'm wrong. If you guys heard anything else otherwise.
I
I
have not heard, but I did hear that they were trying to pass the bill to extend to bring back the 100% uh, depreciation, bonus depreciation.
That's what I
This,
heard.
yeah,
That's
and
what I
I
heard.
just saw it somewhere on the. I think somebody posted it on LinkedIn,
Oh, okay. So
and
so so let's
yeah,
talk about this real quick. So you got the study done. Now, in your case, George, you got 125K off, right? How does that show up? Like, as an investor, what are they looking at, and how are they able to offset it? Like, what piece of documents are they looking at?
Well, they're going to look at an extensive study that's like 30 plus pages that breaks down the components of the building. That's including everything. Like some components are, 5 years, they're 10, 15, I believe. There's going to be 2027, right? As a single family. Now, this property, because it's a short-term rental, it's actually a 39-year schedule, right? So because it is a short-term rental, that only makes a difference on the remaining of the items, right? I can write off 60, 80, last year was 80%.
Right.
So on an 80% schedule, which was 2022, right? I did this study. It was under $1,000, right? And then now I've got this big document, right? And then I give it to my CPA along with, obviously check with my CPA beforehand. And I went back and forth with the cost sec people. And then I didn't know this one thing. Okay, let me point that out. I didn't know that if you purchase a property with a lot of improvements, that it did not matter that the improvements were there. You could only write off based on the purchase price. You can't do these additional costs, additional write-offs that would have happened if I did the improvements. So for those real estate investors out there doing renovations, that actually is an advantage, right?
It is. Yeah, you're right about that. It's based on the purchase price.
Yeah. So no matter what, like one single family home could be a bigger write-off if it's a $500,000 purchase like this property that I'm talking about. It could be a bigger write-off compared to a 10-unit multifamily, class C for $300,000, right? So because it's the purchase price what really matters, right? Which is really cool.
So Tom, I heard a lot of people when they buy properties, right, they go ahead and get a cost sec done right away, and then after rehab, they do another one. What's all that about? Have you heard of that?
So that is also definitely possible. So what George was saying is if you just bought the property, you did the rehab, actually you can do it after
they do a study
that.
before the rehab, and then they do another one after the rehab with the same owner.
And you can depreciate both actually. So it depends on which cost segregation company is advising. If they're really, it's a good strategy that only some people do. So some people outrightly say it's not possible, but there are some. Now, again, guys, cost segregation, this has been very active only in the past 4 or 5 years. So it's not like people have a vast array of expertise in this area. There are some people that have siloed into this and that have come up with really, really great options on how you can depreciate even more. Remember, it's a tax write-off, so they're going to go and exploit every strategy out there. So what they're saying is we bought this building, and now when you put money into the building, right, so any capital expenditures into the building, you can technically come up with some sort of way to write it off, like you said, that how you depreciate in the business where you buy an equipment and you depreciate. So these are all capital improvements that were put into the business to run the business, to run this apartment, right? So that could be technically written off in the first year, just like how you buy a car and write it off. So that's another study that they do. And that's why you hear about, sometimes you hear there is a double depreciation and stuff like that. Have you heard that? Like some people pitch that when you pitch the deal saying, hey, there is double depreciation, or like 120% depreciation, deduction available. And that's what this deal is. They go and do another one, and they add that on.
Explain what capital expenditures are, because we have a lot of people that are watching on some of our accounts real quick.
Yeah, go ahead. Why don't you take that, George? Go ahead and explain what capital expenditures are.
Absolutely. So capital expenditures is still expenses for the business, right? But the difference between those regular expenses, OpEx, and capital expenditures is that they are actually going to go on the balance sheet. They're going to add value to the actual balance sheet. So your asset is going to have more value, right? And
Hmm.
then it's just a different way to write off the expenses, right? And then the advantage is now you can depreciate any capital expenses when you cannot depreciate any expenses that are not capitalized, right? So there's still expenses that go on your profit and loss under your actual profit and loss in your business, right? But they're going to go and they're going to move over to the balance sheet, which helps us when we, if we want to sell the asset, we know exactly how much money we've put into it, right? If we've done improvements, all improvements that are attached to the property are going to be capital expenditures. Furniture for like your furnished rentals, short-term rentals, Airbnbs are going to be capital expenditures, right? Dishwashers, any appliances are all capital expenditures, and they
So
all
are
get.
they going under the business or are they going under the real estate side of things?
Well, I'm thinking in the terms of the owner of the business being the owner of the
Got
property.
it. Okay.
So the
So
business,
under the
like the
business, basically.
owning. So for
So guys,
you,
tell me this real quick here, right? So I got an office building, and we got it about 3 years ago. We did a rehab. We got the dental part done, so the dental office is operating, and I still need to rehab the other
Mhm,
spaces for future tenants, and we need to do the outside, the parking lot, and the whole 9 yard.
mhm.
I've never done cost seg because I was not aware of it back in 2019. Is it still possible to do it now? And I think that may answer for a lot of people who actually have buildings, but they've never done it.
I would check with a CPA, but I literally was just listening to there's a really cool book. This is the second book. It's called Advanced Tax Strategies for the book on advanced tax strategies by Amanda Hahn and Matthew McFarland. And I've read both of them are focused on real estate, right? So I've listened to both of the books. And then he was, I think Hahn was talking about you being able to do a cost seg anytime. There's no year where you can't. Now, if you purchase the property in 2019, now you have the ability to do 100% because you
Still,
purchased, right? I believe so. Don't quote me on it. Again, I'm not a CPA, right? but I do believe so because that's when you purchase the property. So I did meet with my CPA last week to discuss these things, and
uh-huh.
based on what I understand, I'm doing another cost seg for another property, right? And I never did it. Okay, so I never did it. I bought the property in 2018. And she told me that you have to do it for the year you purchased it. But again, like if you do it this year, I'm not, don't quote me on that one, but you can still do it. That's the answer, right? You can do it anytime.
But we would fall under the new 2024 60%, not the 100%, right?
After you already filed everything for that. So correct. Yeah.
Yeah.
All right.
Tom, you know anything about this? Any idea?
No, absolutely. Yeah, you can do cost segregation anytime. If you missed it in the past year or and you bought the property 3 years ago, you can go in and do it right now and take that cost seg now. I mean, there is
But at
nothing that
60%, is that what it is?
that is the questionable thing. That is what I don't know about.
I know
That's the
Okay.
thing you got to check with the
this
C.
year.
Because
What's that?
like
What's
you
that,
like you
George?
had some dentists who asked you that, oh, they've never done it. So that would also definitely help those guys who are listening to it and they want to do it, but they're not sure if it's still the right time to do it or not.
Yeah. I I would have a conversation with a cost seg person, but typically they're salespeople, right?
Right,
So
right.
their team, like I talk to their tax person, right? I don't talk to the salespeople because they don't know anything, right? And
Right.
I've been educating myself on cost seg, and then also I would ask your CPA if you're out there, have a dental practice and
Right,
you
right.
got it like yourself, right? No, so that's what I would do, and have like a serious conversation because this could save you today a lot of money, and now you can do it,
Exactly.
right? You can do
So
it.
so what? No, I don't know if it's 60% or in the prior year that you purchased. That's the biggest question. I don't know. But one thing I know is that let's say you missed doing a depreciation before, right? Like in 2018, you bought the building
Right.
and you did not do it, and you do one today. You did a study today. I know that for sure that somebody had told me this, an expert who told me that you don't even need to amend the past returns. You can do it for this year by filing a form in IRS called 315, 115 or something like that,
Okay.
which allows you to depreciate for what you missed before. The other option is you can go and amend your past tax return. If you want to do that, you can do that. You can amend your 2018 tax return saying that, this was the loss that was not taken. So you can go and apply that. In fact, I have one that I've been thinking about, which my accountant missed when I filed in 2020, I think.
Right.
Sorry, 2021. So I'm thinking of amending that return. So that is definitely possible. But there is also a way without having to amend the return where you can apply it this year for what you missed before. So but I don't know about that percentage though.
Right,
That
right, right. No,
yeah,
you're right. Definitely consult with the CPA and of course the cost sec
yeah,
person and see where we can land up with for sure.
Yeah. Something
100%.
that,
So as an investor, right? They all get negative K1s. Just as a last point, just elaborate a little bit on that. What is that and how does it offset taxes?
yeah. I mean, basically, K1 is, guys, if you're in a partnership with somebody, right? If you any kind of business, real estate business, you will get what is called as a K1 showing your percentage in the business and the profit that your percentage as because of your percentage in the partnership, how much profit it's coming to you, how much profit was paid to you, and how much you owe taxes on that. In real estate, uh, here's the coolest thing. Even though the property is making money every year, you get a negative K1 showing that the property was at a loss. And we call it paper loss because of all these depreciations. And then you take it to the account. Of course, you got to check with your CPA and all these what we said. And if you're an active real estate professional, you can take it off your active income. If
Mhm.
you're not an active real estate professional, you can take it off your passive income. In other words, that statement shows that your property made a loss, although in reality it made a profit.
Awesome.
yeah. Yep.
Awesome.
That's
It's
why
like,
I cannot wait to get K1s every year from real estate income, and it's not like I have to worry about paying more taxes when I get it. So I love getting those
Especially
K1s.
with George now.
Yeah, exactly. George,
guys,
I can't wait for that K1 to come in from your property, man.
yep. I went to a seminar with Brad Sumrock in 2019. It was the first time I ever heard, like, how can you buy so much real estate and pay zero taxes? Well, when you're a general partner, right? You own a percentage, right? You can do that. So the strategy here is what I'm saying is for anybody that has some extra money, right? Buying as much real estate purchasing power, like utilizing, that's what we do, right? We utilize our purchasing power expands, right? And then this is how, like, you only have to buy like two houses really, because most people, I mean, except for, most people can live with like 200 grand, right? So, well, I don't know about Dr. Noel over here. I'm just kidding, right? So,
I'm conservative.
yeah, right. You can actually pay zero taxes if you just buy two properties and you run some of them and you hire people to do these things for you, right? Like run part of it. You don't have to do it, right? And then you're smart about it. You have that's one thing you have to ask a real estate CPA that's familiar with the cost set. Because I was speaking to a CPA about 6 months ago and he was not familiar with it. And he was real estate. Well, he was kind of like everything, right? So it's better to do it with a real estate specialized CPA.
Exactly.
Two pro-
Exactly.
two properties, right? Makes
Yeah.
perfect sense. And if you've got whatever consulting income, any active, like you own a business and you're paying yourself, and you're a realtor and agent, right? Or you manage a syndication out there, right? Or you're a doctor like Noel, right? You just need to operate a couple properties. And if you can buy 2, 3 properties, right? Or an apartment complex, a small 20, 30 unit, right? And then you are part of the actual general partnership,
Sure.
right? You can get those benefits right? Which is really, really cool. Now, I love cost seg, guys.
But here's the thing, George. We gotta understand, like, for the audience, right? We have to understand, like, the study's got to be done. It's not the CPA doing the study. It's not somebody, like, from the CPA
Yeah.
or the accountant's office going to come and do the study. None of that stuff. You got to get a separate specialist to come out to the property. How much would they charge typically for a single family?
About the SDR ones are about 1,500 to 2,000.
Okay.
A full fledged with an engineer come out, I've got quoted 3,000, 3,500 is the highest I've got quoted. And then I'm working with a company that is sort of a like a do-it-yourself, but
Yeah.
like you file this thing and you got to know your property to do it yourself. And then
Right.
if you have your CPA look at it, right, and then you send it back to them and they make the edits, right? So and then it makes sense. I mean, $1,000. Right. So,
That's such a great point, because here's the thing, like me, I didn't know about it. And like a lot of our dental professionals, they don't know about it. Right. So what happens is,
No, you're hitting a very important point here.
yeah,
I was actually talking to somebody from the group, and they own 2 office
right.
buildings. They didn't have a clue about this.
And
Go ahead.
the sad part is, Tom, they go to the CPA, and then the CPA, like the IRS, like I just gave the definition, it treats the building as one unit, and they're just going to, offset it by 27.5 to or 39 years. So when you do that study, so ladies and gentlemen, when you get that study done, basically what it does, it just breaks up the property into not a singular unit, but into multiple aspect of stuff. And now you have different schedules that they can follow. And something which can still be a bonus depreciated, they'll do it for you this year. But it's just going to be up to 60%, but it's still worth it than trying to let the IRS treat it as a singular unit and just making, the whole 27.5 years and stretch it out. And, that's where I was, not knowing about it.
let's talk about some negatives about cost seg. Like, what are some negatives? Like, what could be some things that you got to watch out for, like the don'ts? Who wants to come up?
What is it, George?
Well, I mean, if you sell the asset, right, that depreciation comes back, right, in your balance.
Okay.
But that's why the strategy is to buy a couple properties a year, right? You buy a few, right? Buy a couple a year. It's going against your deductions, right? So, and you got to do it strategically. It is.
Let's say you took the deduction all the way and you sold it. What, you got it now? You owe the IRS.
Now it comes back onto us income. Yeah.
Oh yeah. Okay.
That's
Okay.
called
So how long do you have
depreciation.
to-
Yeah,
So how long do you have to
depreciation
hold
recapture is what it's called.
Oh, okay. Okay. Depreciation recapture. Fancy words, guys.
Mhm.
The same thing happens if you in your business, if you buy a car
Uh-huh.
and you sell it in the same year or second year, whatever you depreciated and whatever you sold it for, I mean, you have to pay back. It'll come back in your tax return. So, I mean, that's a negative of cost seg. It's actually not a negative. There's another way. All you have to do is take that money and go buy another property or put it in a 1031 exchange.
Yeah.
There are strategies around it. You don't have
Okay.
to pay. People, all these smart real estate investors who've become multimillionaires, they have figured out the strategy and they just push the can down the road and they end up paying zero taxes in their lifetime. And then you can pass it on to your children and what is called as a step up step up basis, where they also don't pay taxes. I mean, that's a whole nother discussion. So
Yeah.
it's deferring the taxes.
For
Even
how
if
long
you
do you have to hold the property, or you can is it basically you have to hold it for the full 39 years? Is that what it is?
No.
no, yeah. So now with bonus depreciation,
Uh-huh.
you're not going to hold it for you got the depreciation
Right.
in the first year. So anytime you sell, you're liable to
Yeah.
pay back that
To pay
money.
whatever the remaining, like, pro rata share kind of deal.
Yep.
You want to hold it and plan it strategically, right?
Yeah.
Okay.
You want to hold it and plan
Okay.
it strategically, right? So for us, it was like I did not know about it when I started real estate in 2018. I had no idea, right? So I mean, now it's one of my favorite strategies, right? So especially because it works for us.
Mhm.
Right? So it's all about tax planning. I've spent a lot of hours recently tax planning for our investments to fund our personal portfolio. So,
Awesome.
yep.
Well, I think what else, guys? I mean, I think that's pretty good for tonight, right?
Yeah, this is great, man. I
Have
think this
fun,
is a lot
brother.
of. I wish somebody had told me about this long time ago. I mean, it took me a long time until about 4 years ago. I had no clue about this, and I don't know why nobody talks about this and nobody teaches this in any college, any course that you take. It is a sad situation. This is something should be taught everywhere. This is a great wealth building strategy.
Right, right. And George, you said something about 1031 exchange. I think one of these nights we definitely got to talk about that a little bit.
I think that would be fantastic.
Yeah.
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 Awesome. All righty, great guys. Thursday night, lots of nuggets, lots of gems today. And like always, tune in next week, Thursday night, 6:30 p.m. Central Time. We're gonna land the plane now. George and Tom, thanks a lot, guys.
Thank you,
Always been a
guys.
a pleasure. So we're gonna call it a night, and everybody have a great weekend.
Happy
See you
Have
guys
Thursday.
a
next
great
week.
night. Bye. Bye, everyone.